Welcome to the 13th grade. My name is Elliot Schoner. Let's talk about taxes without hopefully you getting audited. All right, guys, welcome back. My name's Elliot Schoner, and this is one of the last lessons on the actual core of the particular course. After this, we go into a bunch of just kind of short videos about just kind of one percenter concepts. We're going to do a capstone where we're going to just kind of put it all together, and then I'm going to talk to you more specifically in detail about my particular journey and how I use all of these principles to again move me from nothing to something in a very short period of time, starting at about 32 years old with $40,000 in credit card debt, student loans, all that kind of stuff, to now being well into the eight figures, into nine figures, headed towards that direction in a kind of a net worth, which good for my kids because as they say, if you're able to accumulate, sometimes you don't actually enjoy it because you like the accumulation part. So, but maybe your kids enjoy it anyway. So we're going to talk about taxes. In just big disclosure on this one, as we've done with all of the investing up to this part, and if my video editor can put our disclosure up on the screen, that would be great. But we are not, again, I'm not your CPA. I'm not your tax accountant. I'm not the IRS. I'm not a part of the IRS. I'm not your CPA. If you are doing things and you want to do things correctly, specifically around taxes, which is what we're about to go over, you need to talk to somebody that understands the IRS tax code specific to your situation. Some of the things that we're talking about here only work if you are something called a real estate professional, or they apply to different types of people or classes or income levels or whatever. Like there's different things, right? And so even though that I know this information, as I do with all my financial, I still talk to current attorneys, CPAs. I have a whole tax strategist teams that I pay their five figures a year, that I pay to structure our LLCs, to do asset protection, to work us through tax code, tax planning for not only for the year, for the next year, for 5 years down the road, like all the things, right? I still use that because I still like a second set of eyes to give me guidance on what I should be doing. So I'm not that. I'm talking to a camera. I don't know your situation. This is my journey, educational purposes only. Don't go act on things that I'm saying simply because it sounds good. You need to go do your own research. You need to go do your own education. And again, hire those professionals to help you as I do. So, without that said, taxes. Now, most people, most people, when they hear about taxes, specifically, this is a wealthy 1%. This is a 1%er concept, or a 99%er concept, probably, if you're thinking this way. Some people look at taxes and they're like, it's the right thing to do to pay taxes. It's the wrong thing to do whatever you can do to try to pay the least amount of taxes as possible. Let me be perfectly clear with you. The most patriotic thing that you can do for your country, in my opinion, is to pay as little taxes as possible in accordance with the IRS tax code. Okay. The IRS tax code, literally, like, look at the screen, right? So just think of that. 3 books. It's probably a lot more than that. The IRS tax code is like thousands of pages. Do you know what those pages are? The IRS tax code is not thousands of pages of how you should pay taxes, right? It's not. What the IRS tax code is like 2 sheets of paper, 2 pages about here's the tax bracket. If you make X amount of income, you pay 10%. If you make X amount of income, you pay 12%, whatever the brackets are. We'll get to in a second. The rest of it is how you should or how you don't have to pay taxes or carve outs. Carve outs, loopholes, or whatever you want to say it. Congress is not dumb. The IRS is not dumb. Our United States government, the people that come up with this stuff are doing it purposefully. Okay. And so, what I mean by that is if the United States government decides, you know what, it's very beneficial if we get people to get married, have children, because we mean more children in the world, because children means productivity. Productivity means more tax revenue. Productivity means we have enough farmers, enough people in the field to work the fields, or whatever it is, right? The IRS tax code may pass a law that says if you are married, we will give you tax break because you are joint married income. They also may say something like, and we'll give you a child tax break, okay? Or we'll give you a deduction off your taxes for each child that you have, right? The idea being there is that you go have children. They incentivize you to want to have children because we need children. Part of the Social Security method, we're not going to get into it now. Part of Social Security is kind of a Ponzi scheme. The younger people pay for the older people. Well, if there's more older people and not enough younger people, what happens? Well, that's a problem, right? There's not enough young people to pay for the old people. So we need more young people and less old people, right? So that kind of thing. The IRS tax code could also be like, you know what? We need to have more farming because we don't have enough food for our future populations. So let's give tax breaks to farmers who produce corn, which is a cheap product. It has lots of calories in it. Not cheap product, but as a product that has lots of calories in it, we can use it for lots of different things. So let's incentivize farmers by giving them a tax break or giving them incentives on things like wheat, corn, whatever, so that they don't all, I don't know, plant mushrooms or something that maybe are less beneficial, right? In addition to that, the IRS tax code may say, you know what, we need to stimulate the economy, which they did in 2008 during the housing crash, and they needed something to stimulate the economy. They said, our housing market is completely in the crapper. Nobody's buying. People are underwater. We need something to jumpstart the housing market. If we can get something to jumpstart the housing market, we'll build more houses. That means more contractors. That means we need more lumber, more plumbing, more materials, more trucks to transport that materials. We need workers that are out there working. They're going to need places to eat, which means you need new restaurants, and all of that's going to generate more revenue. The long story short of it, the IRS has certain rules and regulations about taxes or tax breaks or incentives to get people to go do things, ultimately to stimulate the economy, which ultimately has a positive effect, which ultimately generates more revenue, right? Which is why, if you are a business owner, you generally may potentially pay less taxes than if you're a W-2 employee. A W-2 employee does what? What do they contribute to society? Whatever their job is. A business owner contributes what? Not a whole lot, right? Or a business owner does what? They hire employees. Those employees do stuff. They produce jobs. All of the employees that they're hiring, what are all those employees doing? They're paying taxes. What's the employer doing to the employees? The employer is paying employer taxes for each employee that they have. They're making revenue. The revenue they're paying taxes on. What are they doing? They're selling. The selling, they're paying sales tax on. The sales tax goes to the city to pay roads and whatever. You get the point. The government needs businesses. It needs startup businesses. It needs existing businesses. It needs business to expand. So there's incentives everywhere for that. So if you ever hear somebody say, well, you shouldn't be doing these write-offs, you should just pay your fair share. You make $100,000 a year, you pay 30% in taxes or whatever, just pay your 30 grand. Not necessarily. The most patriotic thing, in my opinion, that you can do is to do exactly what the government wants you to do, which is to go in and stimulate the economy, to make the economy grow, which ultimately has a net positive effect than you just paying the tax bracket. We'll get to more of that in a second. So, what is the IRS tax code? Like I said, the first couple of pages says something like this, and quite honestly, this changes every single year. So, For those of you who have never seen this before, we're going to try to do whatever we can do to not get into politics here. But for those of you who say like, "Oh, you should pay your fair share," I want you to think about this. If, if you are making only, okay, because this is off, right? Because I think it's 19,000. I think it's $19,000 now for 12%. But anyway, you get the idea. If you're making, like in this case, 11,000, you pay 12% of your income. You have 12% of the 11,600. If you are at 47,150, you pay 22% of your taxes. Now, so you understand, so you guys understand, our tax bracket is a progressive tax system, which means if you make 47,150, you don't pay 22% on the full 47,000. You actually pay 12% on 11,600 of the income. And then the difference between 47,150 and 11,600, like the difference between those two amounts so everything from $11,601 to 47,150, you pay 22%. And anything from 47,150 to 105.25, you pay 24%, so forth. If you end up making, let's say, $250,000 a year, or as a married couple filing jointly, 487,450, it's called $500,000 a year, you can pay up to 35% in federal income taxes. Okay. It's a lot of money. It just hurts my heart, even just thinking about it. And so obviously, if you are making more, you're paying your fair share in the idea that you're paying a higher percentage of your income. No, so if you make more money, you are paying a higher percentage. You're paying more money than the person that is making less money, simply because, let's say, if we all pay 12%, they'd be paying 12% on 11,000. You'd be paying 12% on 243,000. So by that, you're paying more. But not only that, they're paying roughly 3 times more percent of their income into income taxes versus the person that makes 11,600. So that's the case. So when you hear things like, when you hear people like, I think Warren Buffett said like, "Oh, I I pay less taxes than my secretary." Well, his secretary, excuse me, his secretary could be in the, let's call it 60, $70,000 a year. And so maybe his secretary is paying, 22, 24% taxes. Him, Warren Buffett, who makes zero income, which we'll get to in a second, zero income from like a W-2 and makes it mostly off of capital gains, might only pay 15%. It's because capital gains are taxed at a lower bracket or different bracket. So that could be potentially true. I could tell you that I could make over 243,000, but through the rules of depreciation, pay zero taxes. And so is that fair? And I would say to you is that, well, potentially, because again, we're only going to be doing the things that the IRS tells us we should be doing. That's very clear, black and white. I do not do, for the IRS, I do not do anything that's in the gray area. I don't want to be audited. I don't even like the thought of being audited. And there's too many easy ways that you can reduce your tax burden by just doing exactly what they tell you to do, that you don't have to do all the stupid gray stuff. I hear people all the time like, "Oh, you could do this and you could rent your house out to yourself and then you could do the Augusta rule and whatever." Like, you don't need to do any of that. You're like, what the people come to me like, "Oh, I heard you do taxes. What do you think about this idea?" And I'm like, don't do that. Choose a better, like this course is about making sure that you choose the right careers, the right job, the right paths. You don't have to do all this smoke and mirror stuff and end up yourself getting audited and making the IRS mad. So the point is that everyone pays different tax brackets. Now, remember when we were talking about investing and I said a 6 to 8% return on investment is like a really good return, right? And so if you went to like, you could just try it, like go ask ChatGPT, go find a financial advisor. And if you said to him like, "Hey, I have 100,000, I want to invest it. Like, what do you think would be a good return on investment that you could achieve if I gave you my $100,000?" Now, in most cases, if it's a good CPA, they're going to say, "Well, we can't guarantee and blah, blah, blah. We can't guarantee blah, whatever. Do all their disclosure stuff." But then they will say, "Well, if we just put the money in an S&P index fund, we would be getting about an 8 to 10% return. So every 10 years, you're going to double your money." The key there is 8 to 10% return. Now, I want to go back to the graph here then and look at here and go, well, that's interesting, because the tax band is making 12%, even if I'm at the lower bracket, and 35%, even if I'm at the high bracket. Huh. And this is something it didn't really occur to me until I read a book, and we'll include it at mendipity.com because I think it's an actual must read for anybody that wants to be understand tax code and how they should be investing. But the biggest expense, the number one thing you should be thinking about when you're making money, when you're investing, is how do I keep my money that I made, period. Okay, so what that means, I'm gonna use simple math. Remember, I told you before that if you make 243,725, as the chart shows, you're not necessarily making 35% on the whole amount. You're only doing 35% from the difference between 190, 1,950 and 243, right? I get it. But for the sake of just keeping math simple, we're just going to just do it to the whole number because it's easier. Okay. We're going to do some math just based on the whole number because I'm not going to add up the different brackets individual. Okay. So if I was a doctor and I was making 243,725, and I want you guys to put this in your calculator. Okay. So if you have a calculator, put 243,725, right? Now, a good return on investment, if I could take all of that money, right, and I could put into an IRA, right? Let's do something else. Let's see how this is going to work. I've never done this before. 243,725. If you went to a financial advisor and you said, what should I invest each year? Good, put 10% of your income. So multiply that 243,725 times 0.10 equals. And so that's 10% of the income. For those of you who are good at math, that would be $24,372, right? And so I could put this into an IRA account, right? And this is about what you can max out for an IRA or for a 401k. So 22,500. This is 23,000. Let's say we put 10% away, and I earned 0.08% off, or 8%. So I earned 8%. So I took that number and I said times 0.08, which is 8%. I would be making $1,900, $73 a year. And so let me back up, go slow. If I was a doctor and I was making $243,725 and I went into a certified financial planner and I said, listen, I want to deploy this money into something, and what do you think I should deploy it in, and what's a good stock return? And I want you to do that based on the Dave Ramsey method. They would say what you should do is allocate, let's say, 10% of your income or $24,372, put it into your 401k. You'll get the company match. And if you put in like an S&P index fund or a mutual fund, you'll get about an 8 to 10% return. And over the course of a long period of time, you will have a very, very, very nice sum of money. That a 99 percenter, the people that won't be successful and have zero retirements. Remember, we like Stay in America, the people financially coping, financial vulnerable, has zero money saving for retirement. They're not doing that, right? The people that were financially well off, only $106,000 in their account. 43% of the Americans have no retirement savings whatsoever, right? People aren't even doing that. Okay. Hear me out on this. Difference between 99%, 1%. Get this. This is slow down. Rewind the video, play this slow at half speed, right? They're not even doing that. 243,725 in income. We're taking 10% of that income. We're going to put it away. Most people aren't even doing that. Of the people that are doing that, they're putting away 1,949 or 24,372 each year. I'm sorry. They're putting 24,372 each year. They're going to get an 8 to 10% return on the money, which is $1,900. So your smart, financially savvy, the person who thinks they're wealthy, the person that the certified financial planner that went to an 8-week course, which I also did, and they took a little course and they're like, oh, I know about financing because I know the time value of money, and I know about how to do annuities, and I know how to buy. I have a certification. They're going to tell you this: go put in a stock fund, put 8 to 10% return. That's what they're going to do. Now, what wealthy people do is we don't go to CFPs. Mind you, disclosure, we go CFPs, but we don't go CFPs. We go to tax strategists. I hire a tax strategist. I pay a tax strategist. My tax strategist last year was 5 figures. Okay. That does all our attorneys and do all that kind of stuff for us. Okay. The reason why is because they don't tell me to go put taxes and make $1,949 or 8% off the $24,372 that I invested. No, nope, nope. They look at it and they go like this. This is how the wealthy look at it. They're like, I made 243,725. So I want you guys to take that number, okay, on your calculator, and I want you to multiply that by 0.35. That's 35%. $243,725 times 0.35% equals what? Let's see if the camera picks that up. There it is. 85,303.75 cents. If you only hear one thing from this whole course, the only thing that you remember besides change your circle of influence, maybe that's number one. Number two is, well, live uncomfortable so you can live comfortable later. So number three of this, we don't solve earn money, pay taxes, and with what's left over, find the highest return on investment. Why? Because 10% invested, a maxed out 401k at 22,500, at 8 to 10% return, only is going to earn you $2,000 a year. Maybe you get lucky, it's $4,000 a year. Maybe it's blowing crazy S&P index fund, crazy returns, 30% a year. It's still 30% on whatever you put in there in savings, which in this case, max out 401k, 22,500. However, you will pay from the tax man $85,303. That is lost money. That is your wealth right there. Right there, guys. That right there, that's the number I want. That's the number I want you to put up on the wall and say, this is the number that I'm not playing. This little tax, from my video editor, put the tax bracket up. This is the bracket that I want you to put on your mirror, and I want you to stare at that, because this is what we're overcome. The 99% go to work 40 hours a week, 65 hours a week, work overtime, all of that. Get a check, give a portion to the tax man, take what's left, maybe pay all of their bills and have a couple of dollars left over to fund a rainy day fund, to take the kids out and never hit retirement. Financially savvy people go make income. Okay. Make income. They pay all of their bills. They live below their means, and they take 10% of their income and they put it away for retirement, maxing out 401k, maxing out IRA. They go to the IRS at the end of the year and they feel like an attaboy when they're able to say, I didn't have to pay taxes on 22,000 because I put it in an IRA. I'll just pay for it later on down the road. The wealthy, let me hear it clear. The wealthy make $243,725 and they pay zero taxes. And the $85,000 they would have paid, it's put into assets that are growing in 8 to 10, 12, 20% a year. The average person's saving $0. The financial savvy person is maxing out their IRA. The wealthy guy is paying little to zero taxes, and all the money that they would have paid is in assets that are growing and doubling and tripling over the course of 20, 30, 40 years. That is a big, big difference. When I invest and I make money, the only thing that I think about is, where in the hell can I put this money? What is the IRS telling me to do with my money so that I don't have to pay taxes? How will the IRS reward me? How can I do exactly what they want me to do? And if I do that, they'll let me keep my money. Because whatever, guys, whatever I'm doing with my money, based in their eyes, is of a bigger value to the overall economy and overall tax growth than it was if I was to pay that. How do I deploy my money to make more money for the tax man by employing other people, by buying assets that help other people, that ultimately help city taxes, help federal taxes, whatever? How do I do that? That's the difference. Tax brackets for the financially coping, which is funny to me because what I'm saying is like for the working class, right? But what I'm really saying is like, if you are making money and you're getting a huge portion, like I don't know how you do it. Like, how do you make 100 grand, give 20% to the federal government, give another 5% or whatever to the state? So what you have $75,000 left over, and then realistically you could put 10% away. So set another 7 grand. That's not going to get you enough for retirement. So you really need to double that. So 14,000, probably close to 20,000 you need to be putting away a month if you really want a decent retirement where you don't have to downsize and all of that. So you make 100, you have 50,000 take home. Like, how's that supposed to work? I don't know. So, so tax brackets for the financially coping are this. So when you are an employee, financially coping is an employee. Of course, you can be financially coping and be a business owner. You could still struggle. Okay. Your main tax brackets are this. You can put money in a retirement account. Okay. And so what I mean by that, in the idea of a 401k or a Roth IRA or whatever. Remember the example I gave you before, like if you have 100,000 and you put a 7,000 in a retirement account, they won't tax you on the 7,000 of it. They're only going to tax you on the 93,000 that you have left over. Okay, a little bit of tax break. A lot of people are like, "Oh, how do I save money in taxes?" Like, "Oh, max out your IRA and you can save $7,000 and you're not going to get taxed 20% on the $7,000." And you're like, "Oh, $1,400, yay! I saved." Like, that's not a tax bracket. It's called, I don't know what it's called. It's not good. Okay. Second one, a house. And this is kind of actually goes into the IRS, tax code a little bit. One, let's talk about why they give savings for IRA. Well, they do that because the IRS realizes that Social Security is not going to be enough, and they want people to save for retirement. So they incentivize you to save for retirement. Got it? Secondary, house. When you buy a house, the government wants you to buy a house, right? Because when you buy a house, what happens? One, you're more stable. The family's more stable. The family that's more stable is going to be more prosperous. The family that's more prosperous is going to make more income. The more income means more tax dollars. When you buy a house, everyone makes money. You get property taxes. They go to the state. The state has taxes. They can fund schools, firehouses, police stations, all that kind of good stuff, right? When you buy a house, you have workers. They're going to build a house. You got lumber. You got trucks. You got people moving around. All that sales tax, that's also labor. They're all getting paid and they're all paying federal income taxes, right? And so all of that activity, buying a house, building a house, all of that is just creating stuff for the economy. Housing, I don't know what percentage of the economy it is, but it's a larger percentage, right? And so they are all of that's generating tax. So they'll give you a tax bracket, a break on that. How do they give you? They allow you to write off the interest of the house against your income. So you can kind of take that off to reduce your income. Depending on how much that is, you can also get a standard deduction. We're not going to get into it, but basically that's a deduction, right? There's of course other deductions in here. I'm talking about the major ones, like you can donate to like charities and stuff like that and get tax brackets and stuff like that. That's not what I'm talking about because that's usually not the really major big ones for most people. You can have children. And this is an interesting one. I think I alluded this. This is actually my daughter. She's so cute. This is if you have children, you get like a tax break of, I don't know what it is. Is it like, it could be 5,000, it could be 1,000. I don't really know. It doesn't really matter. But you get tax bracket if you have a kid. I think you still do. I think there was some debate in Congress whether they were going to get rid of it or expand it or something like that. But you can get a bracket if you have children. And the idea is there is like America wanted children, like a population, a country needs people because the people means workers and the workers need for productivity because productivity means income and GDP. And you need GDP fund a military and all that kind of good stuff. So, the government, for the most part, wants an American to go work 9 to 5, make an income, pay a certain percentage of that in taxes. But along the way, they would love it if you buy a house, have a family, two and a half children, so they can be productive as well. Enough children that you can replace yourself. They could also pay taxes. Preferably a population that's growing is even better because they can help fund out the older populations. And again, they want you to save for retirement, build a house to stimulate the economy, and then have children. That is kind of it for the tax brackets for the working class, to be honest with you. There's other little things on there. I mean, if you have children, I think there's some benefits there. You can write off like your child care. Again, that's for children. You can write off some medical bills and things like that. Again, I believe that's more children based as well. But again, there's some small brackets there, but those are kind of some of the major ones. You get the point. So, what are the tax brackets for the wealthy? I wonder what those are. Are they different? Are they different for the regular person? And if so, why would they be different? Well, the wealthy are whom? They're business owners, right? And so let's say we're just going to pick someone. Let's say this girl in the center, in the black jacket, long hair, the ponytail off to her right side, is the business owner. There could potentially be some tax benefits for her to go start this business. And the why? Because if she doesn't start whatever company this is, there's what, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 employees. And so let's say she's making, I don't know, 200 grand a year. She hires 11 employees, and all those 11 employees are making, I don't know, $70,000, $60,000 a year, whatever it is, right? Well, without her going and expanding and making that business, those people don't have a job. If those people don't have a job, they're not paying individually their income taxes. If they don't have a good job and they don't have income, they're also not paying sales tax. They're not paying gas tax. They're not paying all those other things. So they want this business owner to go out and build and take risk and to build a company. And along the way, they are going to give that person certain tax benefits or make it easier for them along the way to ensure that they are as successful as possible. Okay, and we're going to get into that. We're going to cover the major ones. There's small nuances, but we don't want to be here forever. So we're just going to cover the major ones because I'm not telling you to go buy these things or go do these things. That's not the purpose of this part of the course. This part of the course is to get your mind thinking about, am I going to do something? If I am going to go do something, I should be doing something with taxes in mind. And so let me go do research to figure out if that thing that I want to do gives me tax bracket. The reason I want you to be thinking about holistically in that way versus like, oh, I should go buy this thing because Elliot says that's going to give me is because every single year the tax code slightly changes. As it is right now, they were going to pass something last year in 2024 that everyone is super hyped about, like in our industry, and then they end up not doing it. And so it was like, oh, that sucks. So we couldn't rely on it. Now we have a different administration this year. They might pass it. They may not. Who knows? It changes every single year. So it's hard. So I don't want you to think about specifically, we're covering concepts of taxes and how it works and how it can benefit you. So that way, as you start to study the tax code, as you stay abreast of what's happening, you can go, oh, okay, great. And this is also why I said to you, I think early on, like your circle of influence matters. What you watch, read, listen to, or otherwise consume matters. Is because when I say you should be reading books and podcasts and things like that instead of watching Netflix and listening to Spotify news. And I mean, I knew everyone needs their break, but you need to constantly keep consuming stuff because tax code changes all the time. New businesses come all the time. Principles change all the time. And so you always have to be staying on top of this. If they pass a tax thing and you didn't know about it because you were just, watching, I don't know, Yellowstone on TV and you didn't you could miss out on literally $85,000 in taxes times however many years you didn't get to participate, not having to pay that, right? So hopefully that makes sense. Business owners, one of the biggest things that they don't pay taxes on are something called business assets, okay? And what an asset is, hopefully you know what this is by this time because we want to buy assets, right? As investors, that's the whole idea is to buy assets that produce cash flow and that cash flow pays for our lifestyle. So if we want to buy like a business wants to buy assets, what are they really buying? Okay. So let's go into it. First one, car. And everyone knows about this, right? Because if you talk to anybody, the G Wagon, I love this car. If you were to talk to anyone that was like a tax guru, or if you're on TikTok or X for like longer than 2 seconds in the last, 2 years, 2023, 24, everyone was like, oh, go buy G Wagon and you can write the whole thing. We'll get to in a second. You can write the whole thing off and you can save yourself so much money. And there's so many things that people saying stuff that was completely not true and completely fake. And that people bought cars that they didn't qualify for. And they're trying to get tax practices and the practice, they didn't qualify for it, whatever. But the point is that the idea, as I kind of said before about the farming equipment, if you bought let's say you were a plumber, right? And so let's use the G Wagon, right? So let's say you're a real estate agent. And so you need a car because you're going to drive around and you're going to show people houses. And you need a G Wagon because you show luxury properties that are millions of dollars. Believe it or not, I could be wrong in this in the tax code, but believe it or not, from my understanding, is if you're a real estate agent and you're showing like like, almost said a bad word. If you're showing like crappy properties, you can't buy a $250,000 supercar, beautiful car, and then write it off. Like there has to be a business purpose for whatever it is that you're purchasing. And a G Wagon may not necessarily have a business purpose if you don't need that expensive of a car to drive people around to show them houses. Hopefully that makes sense. So anyway, so a lot of people are like, oh, I'm going to have a consulting firm. This is what people did. Don't do this. I'm a consulting firm and I have to drive around to talk to my people I'm consulting. So I'm going to buy $180,000 car and then I'm going to write it all off so I don't have to pay taxes. And you're going to get it audited and you're going to get fined and maybe you go to jail for tax evasion. That's not how that works, right? But businesses can buy assets. So like let's say you're a realtor and you're showing, $5 million properties, very luxury. And so you're wearing suits every day and you need kind of a luxury vehicle. It doesn't have to be a G Wagon, but you need a luxury vehicle to drive to and from, right? Well, you could buy a car and basically, if I made $100,000 a year, but because I had that expense, I didn't really make 100,000 because I had to buy the vehicle so that I could go make the 100,000. So the government basically says to you, is like, listen, we get it. Like you need to have a car to go drive around. So we'll allow you to write off some amount of that car against your income so you don't have to pay taxes on all of it. Again, an incentive. I want to make it easier for you to go buy a car. I want to make it easier for you to go buy whatever so that you'll go do that. And then hopefully that produces some sort of more revenue, more GDP, more taxes, and so forth. So a car is a good example of that. It's probably the most famous one for most people because everyone's like, write off the home office, write off your car. Okay, got it. You can write off a car. Businesses also write off electronics, laptop, like the camera I'm talking to you right now. If I was selling courses, which I'm not, and I was making money, and I was like, hey, I could write off this camera because I'm selling it, but I needed the camera to record this, right? So hopefully that makes sense. If I was a restaurant, I had to buy an oven. Well, if I make 100,000, but I could spend $10,000 in an oven, did I make 100,000? Well, no, because I had to spend 10,000 on the oven. And this is no difference than like let's say Nike that's creates shoes. Well, they get to buy a bunch of leather and then they use that leather to make the shoe and then they sell the shoe. Do they pay revenue on the $100 shoe? No, they pay revenue on the $100 shoe minus the cost of all the materials and labor to fix it. So they might only make, I don't know, $60 on the shoe, not 100. And so they pay taxes on the 60, not the full amount. If you're a farmer, maybe a tractor. Now, all of these things, the car, the tractor, the oven, the laptop, all of those types of things, they do something called they write it off based on something called depreciation. And now we alluded to this a little bit earlier on the real estate. Remember when I said to you that you basically take an asset and then the government, the IRS tax code will dictate, we say this particular equipment has a depreciation value of this. So like a tractor could have a depreciation of 10 years. Your car might have a depreciation of 5 years. A laptop might have a depreciation of 2 years. Hopefully that makes sense. There's different classifications for different things. Please go see your tax code. That's why it's so big because it's all in there, right? So it's the depreciation. So if I make 100,000 and I buy a $10,000 oven, which I think I mentioned in a previous video, you don't necessarily take 10,000 off of the 100,000. You would take maybe 2 grand off of it because maybe you're going to write it off for over 5 years because that's the depreciation schedule. So it's 2,000 first year, 2,000 the second year, 2,000 the third year, fourth, fifth, and you get a point until you reach $10,000 and then it's written off. Then no more credit. And so again, the idea is that well, they realize that the company has to then go buy all this stuff. And so if a company spends $100,000 on things that they need to go to start their business, and then they end up making $50,000, like they don't want them to pay taxes on the full 50,000. They will allow them to reduce that amount of income that they made based on the assets they did, based on the depreciation, to reduce the taxable income so they pay less taxes to help them out because they want the business to be successful and grow. Because if the business is successful and it grows, it hires employees and it gets employees to pay taxes and there's payroll taxes and there's sales tax and all that kind of stuff. Depreciation, as we talked about it on real estate, I think we killed this earlier, is pretty grotesque, but it's 27 and a half years on a piece of real estate. A tractor, like I mentioned, might be 10 years. Everyone's a little bit different. We mentioned real estate. I mentioned it in the previous video because real estate is one of those things that we'll call, it's not phantom depreciation, which we'll coin here in a second, but it is a larger depreciation while the property itself isn't actually depreciated. Like, so when you buy a car, right? When you buy a Honda Civic, 10 years later, when that Honda Civic has, I don't know, 100,000 miles on it, it could very well, it's not worth as much, right? So you bought the Honda Civic for, I don't know, what do they go for these days? Like 30 grand. 10 years from now, that car might be worth 5 grand because it's got 150,000 miles on it. It's a little bit beat up. The paint's faded or whatever. It's depreciated. It's a depreciating asset. Real estate, interesting enough, is really one of the things, that's why we love real estate, is one of the things that you could buy it for 300,000. That asset could depreciate as far as the IRS is concerned. So 300,000 divided by 27 and a half years is going to be, what was it, $11,000 a year or something like that. However, that asset over 30 years could go from worth 300,000 to a million, maybe 10 million, depending where it is. Maybe you got in a really great area and it just blew up all around it, right? So you can actually, it could appreciate in price, but it depreciates as far as the IRS is concerned. It's an interesting concept. Very, very powerful. So, covered it. Question. This is what I alluded to this earlier. Again, if you buy a G Wagon for 160,000, God, during COVID, they were like in the 200s because everyone was buying them so much because there were so many people going, I buy a G Wagon and write it completely off, and you drive a weed G Wagon for free. So stupid. Um, if you buy a G Wagon for 160,000, because it weighs 6,000 pounds. So there was a tax code that if you bought a heavy SUV, this has changed since then. If you bought a heavy, well, it's changed, but like I said, always check your tax code because things change back and forth or whatever. But there was a rule. If you bought an SUV and it was over 6,000 pounds, so G Wagon fell into that. The Infinity 7-seater fell into that. The Wagoneer, Jeep Wagoneer fell into that. I believe the BMW 7-seater, well, no, it did because we just did this. So what do I have? The X7s fit into that. The Tesla fit into that because the battery is so heavy that it was all over 6,000 pounds. So if you bought a SUV, let's say for your real estate agent, you bought an SUV, it was over 6,000 pounds. There was a rule for whatever reason. Oh, so during the housing crisis that happened in 2006, 7, and 8, around that time, housing, for those of you young people, housing market crashed, economy crashed. It sucked big time. We showed a graph earlier where the housing prices like went up, but there was a one period it went down. That was that period. Everything sucked. President Obama and their Congress passed a rule that said you could bonus depreciate any asset into the first year. And so what that meant was, let's just take it like what I talked about the oven, right? So I buy an oven and it is $10,000. And the IRS used to say, I need to depreciate over 5 years. So I take 10,000, divide by five, $2,000 a year. So first year, 2,000, second year, 2,000, third year, 2,000, fourth, 2,000, $2,000 a year. Because the economy was so bad, the IRS basically, I think this is the way I was in the IRS. I'm not working for the IRS, but let's just say the economy was so bad that the IRS said, we need people to go do stuff. We need people to manufacture stuff. We need people to buy stuff. We need houses being built. We need, I just lost my light. We need all kinds of things to happen. Okay. And so let me just see if I can do it. Oh no. Oh no, there it is. I guess it was just not a timer. Back in my life. So we needed people, if my videographer, you could just leave all that in. For we needed people to go and purchase stuff to get the economy going. Because if we weren't, we were going to be in breadlines, right? So the Congress of Barack Obama, Congress in I guess '08, somewhere around there, they passed something called bonus depreciation, which said instead of renting an asset over the 5 years, you could pull it all forward for the first year. So if I made $100,000 a year, as let's say as a business, and I had bought an oven, I would only be able to write off. I guess I'm not going to have like I'd only be able to write off $2,000 that year. However, with the bonus depreciation rules, I was able to write off the full amount, the full 10,000. So it's 100,000 minus 10. I have $90,000 left over. So I'm only going to be taxed on $90,000 versus being taxed on 98,000 because I was only able to write off the 2,000. Hopefully that makes sense to you. And so that is enough of incentive, especially when you're talking about major companies on large scales, to get people to be like, holy crap, this is only going to be for the next, usually there's a time limit, like this expires in 5 years or 4 years or whatever. And so everyone was like, holy cow, because we're going to get to the math in a second. That means, I mean, significant tax savings. And if I can then go invest in my business and I can write that off, basically I can invest in my business, grow my business, not pay taxes. Instead of paying taxes, I could just put that money back in my business. Let me go do that. I'm going to explain that to you here in a second. So the idea there was if you bought a G-Wagon for 160,000 and it weighed 6,000 pounds, so it classified itself as a commercial vehicle, you could take $160,000 off your income against the 20% marginal tax bracket. And I think that's what the marginal tax bracket was. I could be wrong, but you could go back in the video if it matters to you, whatever the percentage was. So what that means is if I was making $200,000 a year and I bought a G-Wagon for $160,000, right? I would be able to take 160 off of the 200, so it would look like I only made $40,000 that year. And if I only made $40,000 a year, I would pay my 12% or whatever it is on that 40,000, and I would end up paying like 4 grand in taxes or whatever, 5 grand in taxes, versus 35% on the 200. Let me slow down and say that. Remember let's go back to my editor, like to the tax bracket. Let's go back to the tax brackets real quick. So imagine this. So we go back to the tax brackets here. We would have, if I was making $40,000 a year, let's say I would pay 22%. But if I was making $200,000 a year, I would be up in this 32% range. So let's say I was making $200,000 a year. So I was at that 32% tax bracket. I would be, and you guys should do the math if you have a calculator here, but take 200,000 times 32%. How much is that? Like 60 grand, right? If I bought a G-Wagon, I could bonus depreciate that, take the full value of that G-Wagon off my income. So 200,000 minus 160, it would leave me with $40,000 in taxable income. But because that taxable income was only 40,000, I would be taxed at 22% of that taxable income, which means instead of paying $60,000 in taxes, 200 times 32%, I would be paying 40,000 times 22% or 8 grand. That's a tax savings of 58,000. So the government was basically giving me 58,000 to drive a G-Wagon. So the G-Wagon was not 160, it was 100. And hopefully I'll make sure you understand that. It's like a super, super important concept. Okay. If I make, if I, and goes back to like taxes, taxes, taxes. We do stuff based on taxes. If I'm making 200,000 and I have to give 60 grand of it away to the tax man, I walk away with 140, right? If I go buy, the idea is like if I go buy an asset, I take 160 off. I still own that asset, right? So I have it. The asset, this value that I have. Hopefully I'm making money off that asset, real estate, an oven, still making food that I'm selling or whatever, right? Um, I still have that asset, but I reduce my taxable income, in this case down to 40 grand. A different tax bracket applies because it's just the income of the 40 grand. I might pay 8 grand. So instead of paying 60, I'm paying eight. That's a huge difference of income. That difference of income that I'm not paying in taxes is like free money because I would have had to pay for it. But now I didn't have to pay for it because again, it's in the asset. Okay. So what that does is that means like, holy crap, like I want to go do stuff now. And so that's what happens. And that's the design of the tax code. So as we go through this, I want you to understand that some of you are going to be like, well, that's fair. That doesn't make fair. Like, why is that able to like, so you can go buy this fancy, stupid car, 160, 200,000, and you're going to pay zero taxes on that. But I'm a teacher and I'm making $50,000 a year dealing with freaking little brats and their boogers. And I have to pay all this money. You don't. Well, yeah, that's the case. That's the tax code. Because what happens is, and I love teachers, right? They're great. They're fantastic. Teachers taught me everything I didn't know, right? But you are a W 2 income. The only thing that you're producing is whatever work that you're doing. I don't care if you're a doctor, if you're an attorney, you're only generating taxes and revenue for the United States government based on your productivity, right? And your productivity and the amount that you generate, that's what the marginal tax rate is. However, as a business owner, if I own a restaurant, I might hire 30, I have 35 people. So I'm producing not only the income that I'm making, but I'm producing income of 35 people because those 35 people don't have a job if I'm not working. And again, those 35 people all produce taxes. I pay as an employer, I pay taxes for those 35 people because I'm paying employer Social Security, Medicaid taxes. The employee pays federal income taxes, Social Security, Medicaid taxes on their half, right? And that business is generating sales tax, which is good for the county. And I'm paying property taxes and all the property that's inside the business. And I'm paying property taxes like the actual not just like the oven property taxes, but like the actual building that also goes to the government that helps fund schools and firefighter, whatever. So if I don't do that business, there's no firefighter, there's no police, there's no other jobs, whatever. Everyone's in breadlines, right? And that's what was the story in 2008. So the government comes and said, like, hey, we need people to go do stuff. So they pass all these tax, which makes people go do stuff. And what happened? Shoo, the housing market recovered. The economy recovered. Great tax policy fosters productivity. Okay. Very, very important. So the question here that we have is wasn't the question. The question is not, should we be giving tax breaks? The question was not, does that make sense or how much should I be paying or whatever? The question is, it, a rule of the okay, the 99%. I love this analogy, and I came up with this. I'm going to keep doing this over and over again. The 99 percenters, financially coping, financially people, financially healthy, whatever, the regular, average, everyday people, they're not saving for retirement, not even putting anything in retirement, whatever. They go to work, they work the 9 to 5, they pay their taxes, and they scream and they tweet or they X, I guess, and they say the wealthy need to pay their fair share, and they get frustrated and they pay their taxes and whatever. That's it. The financially savvy that think they're really doing something, they're like, oh, I'm the 1%. Max out the IRA, max out the 401k. They write off their home office. Whatever. Doesn't matter. They do great stuff. They rent out their house to their Augusta rule or whatever crap that is, right? Stupid stuff. Nickels, pennies, right? And they think, and they buy a G Wagon and they make TikToks about it. But they buy a G Wagon, they make $200,000 a year, and they're like, I'm an attorney or I'm a real estate agent, so I'm going to get my G Wagon and I'm going to drive around and take pictures of it and I'm going to write it off and then I'm going to tell people how smart I am because I bought a G Wagon and I got to write it off. Well, if you made $200,000 a year and you spent 160. So your net income was 40. So you had to pay $8,000 in taxes, 40 times the 20%, whatever, versus the 200,000 times the 32% or 60 grand. So you paid, not 60, you paid 8. Sure, you saved in taxes, but did you really save? Because you bought $160,000 vehicle, which is an actual not only depreciating asset with taxes, but is an actual depreciating asset. No. Financially, people who think they're financially smart, and it's okay, you saved a little bit. Maybe you deployed that money that in tax savings into something else. Okay. Think they did pretty good. Financially savvy people who think they're like wealthy and think they should are doing all this kind of stuff think that if I own a business and I go buy a laptop and I write it off, I'm being smart because I have a write off. If I go buy a bunch of suits, it's a write off. If I go out to eat with my friends, I'm going to write off a portion of that because it's a business meeting and I can write off that half of it, not my half, but their half of it. If I, and they just add it up, like they're going to go spend a bunch of money and think that I'm not going to go to business. And yes, I'm having a beautiful lunch. I'm going to write off half of it and I'm going to tax break because I'm savvy and I'm smart. No, you're an idiot. You don't understand math. Because if I make 100,000 as a wealthy person, you know what my number one concern is? To keep $100,000. Wealthy people, people that aren't financial literate, just pay taxes. Those financially savvy people make money, but then spend all of it and then feel good about themselves because they can call it a write off and they get taxed a little bit because they spent all of their profit. Wealthy people make money and they keep all of it because they do something called phantom write offs, which is where we spend $0, give or take, but still get the tax benefit. Let me explain. I coined this phrase, by the way, it's phantom write off. So if you see it anywhere else other than here, it's fine. I only coined two things: the pain abundance curve, which maybe one day I'll do a TED talk on, and the secondary, it's phantom write offs. It was funny the other day. I was on YouTube and I came across, and maybe people just know I want to go speak and help people out. But there was a whole guy that was running courses. He was actually selling people on how to make them better speakers so that they could go to TED Talks. I was like, man, people are selling courses for anything these days. So a phantom write-off is using, I wonder if you guys would get this. I want you to write in the comments below if you can guess. God, I wish I was live so I could just like give out like $10,000 to somebody who would actually come up with the answer to this question. What you've been in this course now for this is lesson 20. I've been talking for a long period of time. What tool do you think we use of what which we've learned so far to make or create phantom write-offs? If you have, comment below. Even if you're not watching this live, just comment below. If you're on Medippy.com, I guess you can't comment. If you're on YouTube, comment. Or if you see this somewhere else, comment. I'm interested to see who actually gets this. If you get it, man, you're on your pathway. If you said debt, you would be correct. So remember when we talked about the Grant Cardone method and the debt flow method. My logo down there, debt flow method. The debt flow method or the Dave Ramsey method. Like Dave's so against debt, and I get why. If you don't know Dave, I don't think I covered this, but like if you don't know Dave, he's really angry about debt because like he actually invested a lot of real estate and got like tons of debt. I'm sorry, Dave, if I get this wrong, don't sue me. Something like that. He got like it's in his book, whatever. But like go read his book. It's actually one of the recommendations. You should go read it. I think it was in like lesson 5 or something like that. I told you to go read Dave Ramsey's Money Makeover. You need to understand his thing before you do anything else. But I think he got a bunch of real estate, and then some. I think it might have been like '06 or 08. Like he couldn't pay for it, and then when he went belly up. So and so he has this really bad taste for debt because he's like, well, if I didn't have that debt, I wouldn't have had to file bankruptcy. Or you could have just managed stuff right and made better choices. But whatever. We're all damaged in some way, and then we do the opposite based on that damage. So, however, the reason why you need a good credit score, why we cover it in the beginning, and why I made this course because it's not trained anywhere else is because it is such a critical piece that you understand not only how to build amazing credit, but what's in your credit score so you can have a 800 credit score and go develop really amazing relationships with big banks like the big banks that are out there. You drive around, they're everywhere. Small little local banks. Like when I put my money places, I got big banks. I have all the big accounts with all the big banks. Just spread it around. I don't care if you have $400. Go put $100 in each one of the big banks. Relationship with the big banks. All the small credit unions, put $100 in all the small credit unions. The online accounts, the digital online accounts, put money in there. I have Robinhood. I put money in Robinhood just because I'm about to give them. I build relationship with everyone because it is something when you call the place, like when I call American Express, and they're like, oh man, you've been with us for 24 years. Amazing. Thank you. You've been here for 24 years. You know what I'm going to do? I'm going to waive your annual fee of $800. You have a good life. Thanks for being with us. Keep charging. Anyway, develop relationships. But debt is how you get to phantom deductions. So, car. Let's talk about it. We did this at we have a Tesla Model X, the one with the doors that go like that. And we bought that car. Not that I like Tesla. We bought it for real estate during the 6,000 pound deal. We bought it for real estate because it was 6,000 pounds and we didn't like the look of the other cars. The one we found was used. So we didn't buy a new car because buying new cars are dumb. That is good for the Dave Ramsey method. He tells you how to buy new cars. I agree. Usually not a good idea unless you just really want a new car for some reason. You just have tons of money just to kind of waste. But we bought it like it was like a test car or something like that. So we got it used. It cost 6,000 pounds. And you know what we didn't do is we didn't go pay cash for it. You know why we didn't go pay cash for it? I hopefully you know by now. And if you don't, actually, if you don't know the answer to that question, why we didn't pay cash for it, this is what I want you to do. Because this is what I would do to my kids, and this is what your dad would do to you. Stop this and go back and just rewatch everything again. Just rewatch it all. Because you're not quite there yet. We didn't pay cash for it because the car was 72,000. I think now they're like closer to 100. It was 72,000. And what can I do with $72,000 in cash? The interest rate on the loan that I received in 2017, 18, something like that, was like 3%. So instead of saving 3% and buying the car for $72,000 in cash, making 100 and spending 72,000, so not making 100 because I spent 72,000 on an asset or an expense or a write-off. We took the 72,000 and we put it into a rental property. The rental property that we produced about, let's say, just say $500 a month. You know what we did with that $500 a month that we got from the cash flow of the property? We used it to pay off the $72,000 car note. Okay. What was the good thing about the $500 cash flow that we got from the real estate property is that the $500 we made in cash was also tax-free. It was tax-free because we depreciated the asset, the house, over 27 and a half years, which means, let's say we got $11,000 and we only made $6,000. So we had a negative cash flow. And so we paid zero taxes on the cash flow that we received, although we used that cash to pay back the car note that was at 3%. The house continued to appreciate. That was actually this is honest God, true story. The house that we purchased for $181,000. We put down like 40, 50 grand on it. It wasn't even the full 72,000. We rented it out for 1,500. The house I told you about earlier, it now rents for 2,200. That house is now worth 400. 400. We bought that house for 181,000 after it was sitting for a while in a really crappy, weird neighborhood. But we knew the location, because we're real estate agents. Things grew up around it, and now it almost doubled. So I could have purchased the car in cash the way Dave Ramsey would have done, and what I would have had was a $72,000 asset that would just be sitting there. But not bad because I potentially could get some tax breaks from it. Instead, I took the 72,000. I took the loan out for 3%. I had a payment of doesn't even matter. I bought a house instead. I took the house and I took the cash flow from it that paid for the car. I got appreciation of $200,000, which is almost 3 times as much as I would have saved if I would have bought the car outright. Plus the mortgage is being paid down. Plus, because I depreciated the house, I got all the cash flow for free. And again, the cash flow I used to pay for the car. So I drove the Tesla Model X for free, give or take, because then I put the $72,000 on it. Now, interesting enough, so I took out a loan. And what that means, and the point of a phantom deduction, means I'm taking a deduction off an asset that I purchased, but technically I didn't purchase it. The bank purchased it for me. And the bank purchased it for me because I gave them something else called leverage, and I'm going to give them a little bit of money. Why don't you think that then? Let that sink in. So let's say I made $100,000 for the year. I bought a $72,000 car. The $72,000 car was over 6,600 pounds, so it was a heavy SUV / commercial vehicle. The tax code said that I could bonus depreciate that entire car instead over 5 years into my first year, which means the $100,000 in income that I made that particular year, I was able to write off $72,000 of it off my income. So I'm going to take out a calculator because I'm going to add some more math to this. $100,000 minus 72,000. So that year I made $28,000 in the eyes of the IRS because I wrote off a $72,000 expense. However, was it an actual expense? Like if I went and bought a laptop at Apple for $1,000 and I wrote it off, I actually spent the $1,000, right? But I didn't. The car I financed. And I put zero down because I have an 800 credit score and I don't need to put money down when I go buy a car because I have an 800 credit score because I worked on my credit since I was in college, which is what you're going to do because you're watching this course. Which means $100,000 that I have, I subtracted the $72,000 for the car. I have $28,000 in income that I'm now going to be taxed on based on the tax bracket of, what was it, 15%? Let's just say 20%. The car, I now have a car payment of, I don't know, whatever, $1,000 that I have. Now I still have the cash that I have, but instead I'd want to deploy those resources to something else. So I put 5% down on a property that was $181,000. I took the $181,000, purchased the property. I used $181,000 over 27 and a half years to get depreciation. So the cash flow that I received from that property, I earned tax free because I'm also depreciating the house against the cash flow that I received from the rental property. The cash that I received that is now income, I took that and I used that to pay off, let's just say, a portion of the car payment. So it wasn't $1,000 car payment, but needless to say, I didn't have to worry about the 3% interest because my rental property or my renter was paying for the interest of the car anyway. I didn't pay taxes on the rental income. The asset appreciated, the house appreciated $200,000, and the mortgage got paid down over the last several years. I put out in this deal $0 to purchase the car, but I still got a $72,000 deduction. I'm using the $72,000 down for the down payment in the house just to give you an example of should you be putting money towards not having debt versus investing it. And this is a good example of how you should invest money instead of necessarily trying to save on debt. But it works just the same, even if I didn't put it in the house to get the cash flow to do whatever. Now, because I put it in the house as cash flow, the cash flow that I had didn't fully satisfy the debt that I had to write off, remember? Now, here's the crazy part. The house that I had was 27 and a half years. However, there's this thing called bonus depreciation. And because I qualified for a real estate professional, we'll get into this maybe later down the road, but I didn't necessarily just get to write off the house at 27.5%. So it wasn't just at 27.5% that I got to reduce. Instead, I got to write off a lot more than with the cash flow. So let's just say, for sake of keeping things easy, let's say I made $5,000 a month, $6,000 a year off the rental property. My depreciation for that particular property itself was about 20% of its value, 25% of its value, really. So at $181,000, if I took 25% of that, I got to write off $45,000, $250 off the first year off my income because I bought an asset like a house and I was able to bonus depreciate a portion of that or pull forward based on the new tax code that came out in 2008 based on the housing crisis to get people to stimulate the economy. So when I took the $72,000 and I put it into the $181,000 and I was able to get $45,000 in bonus depreciation, I felt pretty good about that. But remember, I made $6,000 in cash flow. So I had to take off $6,000 off that cash flow because 45,000, part of it was eaten up by the 6,000. I then had $39,250 left in depreciation, right? Still left. We're going to recap this. However, remember when I told you I bought the car for $100,000 and then I subtracted the 100,000, but I didn't really buy it. I just financed it, but I still got to write off the 72,000, the value of the car, and I was able to get that the first full year. Well, take out your calculator and multiply $100,000 minus 72,000 equals $28,000 in taxable income. But remember, I just told you that I bought a property with the 72,000, and that property I was able to depreciate 25% of property via something called bonus depreciation and pulling forwarding via cost segregation analysis, which is the tune of 45,000. Now I had to add the 6,000 I got in cash flow to my 100,000. So it's really 106,000 I made, 100,000 from my income from what I was making, the $6,000 that I made from the cash for the property, minus 72,000 depreciation for the car, which I did not purchase, zero down, so zero money into it. But I did actually, technically, I own, or I'm sorry, I control it. I don't own it. We had a lesson about that earlier. Remember I did that? Well, go ahead and subtract it. I have the 28,000. What do I have left over? And then subtract the 45,000 for the house. So I know I did a lot of math there. What I want you to do is if you're getting confused and you're like, what the hell is he talking about? I'm so confused. That's what I want you to do. I'm going to take a piece of paper. We're going to do it together. I want you to write Tesla, $72,000. Okay. Above that, I want you to do income is $100,000. And let's say like this. Let's say I made $100,000. You probably can't see that. The camera's not going to zoom in. Let's say I have $100,000 here and I made an income and I subtracted 72,000. So I have $100,000 in income and I have $72,000 that I'm going to write off because I bought a Tesla. That comes off my income, right? That leaves me $28,000 in taxable income. Now, remember on that 72,000, I went over and I purchased a property with that, okay? Now, the property was worth, write down $181,000. I want you to take 181,000 in a calculator, and I want you to multiply that by 0.25 or 25%. That is 45,250. So that is the amount that I was able to depreciate, give or take, the first year. Just like I bought an oven, I can depreciate real estate. Normally, what we've talked about it up until this point was that you had to do that over 27 and a half years. However, there was opportunity that you could pull forward certain parts of that property via cost segregation analysis. That's a whole nother video, so that you could depreciate more than just the 27 and a half year value. So instead of taking 181,000 divided by 27 and a half years, again, something we covered in previous videos, and that would be your depreciation off your income, I'm able to take off 45,000. Okay. So if you're on your sheet of paper, you have income of 100,000. Let's just say that's your real estate business because you're a realtor, right? And you made $6,000, write that down, $6,000 off of the rental income that you spent, right? So instead of taking the 72,000 and buying the car, you bought a rental property. So you made $100,000 off your job. This is real estate agent. You say you did property management, you just did real estate stuff. And you took $6,000 because you made 6,000 in cash flow off the real estate property. The total amount that you made is 106,000. Now, if I was a pharmacist and I was making 106,000, go back to the tax bracket. What is the tax bracket I would be taxed on? I don't even want to go back and look, but let's just say it's $106,000. And let me multiply that by 25%. Let's just say I got taxed 25%. If I made $106,000, I would take home, or I would have to pay taxes on rather, of $26,500. So I would lose 26,500. A lot of people say, "Oh, you're just sending that to IRS. You didn't lose it." No, no, you lost it. That was your money. I worked hard. I went to school. I did whatever I needed to do to make that money. I went to work. I worked 40 hours a week. I was away from my family. I earned 106,000. I have to pay 26,500 to the taxes unless you have a mind of the wealthy and you took this course. Then what I did, again, I didn't buy the car. One, I chose a degree in an employment that allowed me to do this. I didn't want to be a doctor. I want to be a plumber, electrician, a real estate agent, something that allowed me to have assets that I could depreciate. So I was a real estate agent instead, and I only made 100 grand, right? And then I bought a rental for 72,000 because I was in the real estate industry. And so I made $6,000 off of the rental income. So I made a total of 106. And I would normally have to pay, again, the 26,500. But because I bought a Tesla, it was 6,000 pounds and I could bonus depreciate that. I could take $72,000 off the income. So take 106, take your calculator, $106,000, right? And then minus the 72,000 depreciation for the Tesla. I have $34,000 in taxable income, right? Got it. And so I'm going to have to pay taxes on $34,000. Wait a minute, but I have the property as well. Remember, I bought the property for 181,000 and I'm going to depreciate that asset. But I'm not just going to do it off of 27 and a half years. I'm going to do a cost segregation analysis. I'm going to do a bonus depreciation in any 10, 15, and 5-year property. I'm going to pull forward to the first year via the tax code as it was written because the IRS wants you to go do these things. Okay. That amount of money, 25% of 181,000 is $45,000. What is $34,000 in taxable income minus $45,000 in income? Zero. It's a negative, folks. Okay. And so if I'm a pharmacist, let me explain this to you. We're going to go a step further. You're going to like this. So if I'm a pharmacist and I'm making $100,000 a year, I think that's what pharmacists make. If I'm a pharmacist and I make $100,000 a year, I'm going to pay, give or take, $26,000, $25,000 to the federal government in taxes, federal, state, whatever. However, if I'm a real estate agent and I make $100,000 because I decided a different career choice, I didn't go to school. I went to a 2-week class versus pharmacist, probably 5-year degree. I didn't rack up a bunch of debt. I chose the right path because I was educated. I took a course like this, which again is why we're taking this course. I didn't pay $26,000 because what I did is I used the tax code at that current time that benefited people that are business owners. And so I went and I bought a Tesla, but I didn't put any money down on it because I have a great credit because I've been building my credit forever. So I didn't put anything down in the car payment. And I wrote $72,000 off my first year of my $100,000 income, which brought it down to $28,000. And then I bought a property with the $72,000 instead that I had saved because I've been working or whatever. And then I used that property to depreciate to bring my income down to zero. So as a pharmacist with your big college degree and all of your student loan debt and all that kind of stuff, you paid $25,000 a year. And so after 100,000, you had roughly $75,000 left over to play with. And then of that, maybe you took 10% of it and put into a 401k or an IRA. So then you had like about $62,000 to play with. And so you had about 5 grand a month or so to pay your bills. Me as a real estate agent, I'm driving around in a Tesla Model X that's being paid for by my rental property. My rental property is going to double in value of $200,000 over the next several years, which it actually did. The mortgage of $181,000 is being paid down. And of the $100,000 in income, I paid zero taxes. And you know what it cost me to pay zero taxes? $0. Now, you might be thinking to yourself, well, wait a minute, Elliot, that doesn't make any sense because it did cost you something because you paid $72,000. And so what you just said to me was like, well, if you had to pay 72,000, did you really pay 72,000? Oh, sir, just warming you up. So, piece of paper. You make $100,000 in income as a real estate agent, and you decided to do real estate agent. Hell, let me just make it easier for you. Let's say you decided to do wholesaling, and you got pretty good at wholesaling where you did one deal a month, hundreds of calls a day, one deal a month for $10,000 is all you made each deal. So you made $100,000 a year, $120,000 a year. We'll just say 100 grand because you took off December to go travel. You made $100,000 a year doing wholesaling. Of the $100,000, because you're a real estate professional, you're a real estate industry, and you drove around and all that, you decided to buy the Tesla X at $72,000, and you get to write off the $72,000. But again, you didn't put any money down because you had an 800 credit score, $100,000 in income, $72,000 down. You have $28,000 in taxable income. But now you want to do something to get rid of that $28,000. What could you possibly do to get rid of the $28,000? Let me think about that. I know, because the only thing we think about is how to get rid of taxes. And we know we can get rid of taxes over depreciation. And we know the way that we depreciate stuff is by acquiring assets. So we need an asset. But now you're poor because you only have $100,000 and you got bills to pay and stuff like that or whatever. And so how do you do that? Well, you're a wholesaler. Remember I told you about how you want to wholesale early on in the beginning? Well, you bought your property. Go back 5 or 6, 7 slides, 2 videos or so. You bought your property for $180,000 and you put $45,000 into it that you saved. And then you refinanced it. What'd you do? Because you were into it for $225. Remember we covered this? And when you were in for $225, you rented it out for like whatever, $2,000. You refinanced it, you pulled out your money, you got the property for $0, but you're making $500 in cash flow. So your income was not 100, it was 106,000 like the previous example we just did. But the 106,000 got reduced, right? Got reduced because you had the $72,000 Tesla you just purchased. So again, 106,000 minus 72,000 equals the 34. So just to kind of recap, so what we're talking about, and I apologize, I'm gonna go back and just repeat a little bit just so make sure you have the right context, is if I had $100,000 and I wrote off the $72,000 Tesla, and again, so I increased that because of 106,000 because I had this rental property that was giving me $500 a month or 6 grand a year. My total income was 106,000. Okay, and so again, just going back to that calculation, 106,000, and then I subtracted the $72,000 Tesla that I bought. Again, not putting any money down because of the 800 credit score. I didn't even put any money down. So I'm getting the $72,000 deduction even though I'm not spending any money. So I'm keeping all of the 106,000 that I have. I'm just subtracting the 72,000 because it's a phantom deduction. It's a deduction that I'm able to take even though I'm not actually putting out any money. I would be paying money over time, but that's okay. I'm just not doing it necessarily this year. So of that, I would have $34,000 left. Now, I'm a big proponent that I don't want to pay any taxes whatsoever. So remember the $6,000 that we're actually getting from another property, right? But how do we get that property? Do we have to spend money on that? No, because we're wholesalers, right? And so what we did is we went and found our property. We bought it. Again, remember the previous example. I bought it for $185,000. I put $45,000, $50,000 renovations. So I'm all in for like $220 or whatever. I go to the bank. I refinance it because of the value is now worth $300 because I and renovated and I got some equity there, I'm able to pull out all that cash. So the bank's going to give me all my money back, which means how much money do I have invested in that property? The answer to that is zero. But I'm still going to get the cash flow because the mortgage, let's say, is $1,500. I'm renting it for $2,000, so I'm getting $500 in cash flow from that. I take that $500 and I use that to pay the Tesla. That's not going to cover the whole Tesla payment, but it's going to make it easier. I feel like the Tesla payment was like $1,000 or something like that. So if I'm paying $500, it's half the cost, right? All in all, I am paying money on interest on the home. So bad debt's bad in accordance to Grant Cardone or whatever, right? Well, not necessarily, but like that mortgage has debt on it, but I'm not paying it, the renter's paying it. And the car has a rate on it, like let's say 3% they're charging me on the $72,000 annually, but really the renter's paying it off, so I'm not really paying that either. I have both a house asset and now a car, and I'm able to keep a majority of my income with all in all paying out maybe $5 or $6 grand a year. I mean, think about it, right? And so if you're thinking about the wealthy, not only are you saying, okay, I want to make $100,000, right? But how do I do something to pay that off? Well, this year I'm going to do $72,000. I'm going to pay the car off, right? And then I'm going to get an asset. I'm going to do the Burr method. So I'm going to get a house. I'm going to get a property. The property, because of bonus depreciation, I'm going to write off $45,000. If I'm only making $34,000 and I have a write-off of $45,000, I'm actually negative, and I carry that over to the next years. So I can make $100,000 as, let's say, a real estate professional, as a realtor, and pay zero taxes. And after a 2 weeks course to get my realtor's license or whatever, with a person that may have necessarily went to school for 5 years, 6 years, whatever it is to be a pharmacist, they're making good money. They're making $100,000 a year, but because they're having to pay the taxes, they're putting $26,000, they're putting $25,000, whatever, to the government. Let's say it's 20 grand to the government, whatever it is. It's 20 grand to the government, right? That's a tremendous amount of money. But ladies and gentlemen, that's not enough. That's not what I'm talking about, because you're wealthy and you have a wealthy mindset. And so on initial, let's just take those two scenarios, right? The idea is $100,000. One person has $100,000 and they net 75, right? Because they net 75,000, they're able to only put 7% away. So they put $7,000 into their IRA, okay? And so that's $7,000 a year. We know if they do that for 35 years, they're gonna have like $1 million. We did that like 10 videos ago. Because I have $100,000, if I keep the same mindset, right? Where I'm like, no, I need to constantly keep investing, keep building, keep snowballing. What I'm going to do is I'm going to say, yeah, I would have had to pay $25,000, right? But I'm not going to pay the $25,000. I'm going to keep it. So what am I going to do with the $25,000? Am I going to go out to dinner with that? Am I going to go on a vacation with that? I could, maybe, potentially, but probably not. Let's just keep it even. So let's keep the even scenario. The pharmacist is putting $7,000 away because at $75,000, when they put 7 away, they're walking $68,000 to live on. That's not a whole lot. My $100,000, I can actually put away not just $25,000 plus the 7, which is 32 grand, right? So to keep things equal, take $100,000 minus 32. It's the same amount of money as $10,000 minus the $25,000 in taxes to their IRS, minus the $7,000 to the IRA. The pharmacist is saving $7 grand a year. And the $7 grand a year is going to be $1 million in retirement, and they're going to feel good about that. And the financially savvy people, the Dave Ramseys of the world, would feel pretty good about that because they're maxing out their IRA every year and they're on their path to becoming. That's way more than the average person, the 99% of us. But we're wealthy. We want to create generational wealth. So we're not doing 7,000. We're literally doing, 4 times that amount of money. Which means instead of having $1 million in retirement, we're actually going to have, $4 million, $5 million, $6 million in retirement. We make the same amount of money per year. We just did choose different careers. We had different jobs, and so therefore the outcome was different. This is what's so powerful about being financially literate and understanding the way the wealthy operate, the way the people that the way that maybe everyone else operates. Okay? The 99% don't do anything. The financial savvy people, yeah, they max out the IRA. The generational wealth people pay zero taxes, and what they could have sent to the government, they take that money and they put it into their retirement, they put it into other assets, and those compound. So instead of putting away $7,000, they're putting away $30,000, $40,000. In our case, sometimes $100,000 a year instead of paying taxes on it. That's the difference. I want to cover one more way, one more business of phantom deductions, and then we'll kind of leave it at that. Remember when I talked to you about a dumb business and why you'd want to do a dumb business? It kind of feels in it fits in the same category. Dumb business is a laundromat or something else that creates that's creating revenue, right? That we didn't necessarily have to put a whole lot of money down. We could have put some money down or whatever. But same thing. Let's say I buy a business for $300,000, right? That $300,000, if I buy the correct business, is going to have a bunch of assets, machinery, equipment, things like that. So let's say I buy a laundromat. As I buy a laundromat, I'm probably not buying the building per se, although I could be. I could probably not building. I'm probably more so buying like all the equipment and stuff like that as well. So let's say of the $300,000 purchase, I don't know, $100,000 of that is just because, like just the purchase price, right? You're buying the concept. It's called goodwill. But let's say $200,000 of that was actually the equipment. We could say, well, I'm buying, I don't know, 45 washing machines or whatever, right? And so when I acquire that dumb business, and let's say it was somewhat, or I think our example was $360,000 before, I put down 60 grand, and then I did seller financing for the rest of the time. I own that business even though I didn't buy it and I financed it. So I may put down $60,000 to purchase it, but if the assets inside, the depreciable assets inside were worth 200, I gained 200 in depreciation. Hopefully that makes sense to you. Very similar to the car, right? So yeah, I put down 60,000, but I gained 240. And so if I'm in a climate where I can actually bonus depreciate all of the 240, remember in that previous example, if you go back a couple of videos, in that example, we said the business was making about $10,000 a month or $120,000 a year. That means I can say, well, I'm going to buy, or I bought the business for $360. I put $60,000 down on it, but because there's $200,000 in assets in there, I'm going to bonus depreciate the assets. Well, what that means is that even though I made $120,000 a year, I took $240 off of that income, which means I'm negative. Which I have a negative depreciation on that, right? And so what that means is like I'm getting that business and now I'm earning 10,000, I'm getting all of that revenue, at least for the first couple of years, because I'm depreciating those assets. I'm getting it completely tax-free. And that just accelerates my ability to pay down or pay back the seller financing, right? And if I can do that, maybe I don't have to pay anything. Like if I made $120,000 and I didn't have any depreciating assets when I purchased that property, yeah, I'm making $120,000 a year. But again, I'm only going to walk away with like 80. And so if I had to pay this guy back, like I don't have all the, like if I got to pay him back a certain amount, like I only have 80 grand to pay him back versus 120. If I can depreciate the assets because I know I'm buying something with the actual assets in it, that means when I make the 120, I buy the 120. Which is why when I go buy a business, or you go buy a dumb asset or something, if I buy, let's say, a real estate agency, that what I'm buying is really the book of business, and the book of business I'm getting is just names and revenue, what's the asset that I'm purchasing that I can depreciate there? There is nothing, because I'm just buying an actual book of business. I'm buying revenue. I know I'm getting complex here, but I'm just buying revenue. But if I buy a laundromat, I'm actually buying machines and equipment. I can depreciate it. So if I could buy a $300,000 for insurance agency or a $300,000 laundromat, the wealthy guy is going to buy the laundromat because I know I can take away the assets and I can depreciate the assets, and then I'm actually going to get that revenue tax-free for at least a couple of years. You could make an argument that says, well, after that, then maybe this one's a little bit better. Maybe potentially. It kind of depends. But the idea is that you're thinking about it. So That is phantom taxes, phantom depreciation. There are two more concepts I want to go to. I'm going to leave it there because we went through like a crazy amount of content. I want you guys to really watch like the last 2 or 3 videos again, because we went through a lot of concepts and we really started to get into some of the intricacies of things that are actually possible. If you can take one thing from this, just remember what I said to you is that when you earn income, you're going to pay a certain tax bracket on it. The wealthy are constantly thinking about, how do I not pay taxes on that income that I made? And if I can do something like investing in assets or investing in something else that the IRS is telling me to do based on the tax code, no loopholes, no cheats or nothing like that. Like, they basically, it's clear as day. Let me go do that, because I rather retain my income, even though I'm putting it into an asset like a house or a piece of, or something else, than give it to the IRS. Especially if that asset is actually able to appreciate and make me money. Hopefully that makes sense. And in some cases, the best case scenario is we look for things called phantom, what I call phantom depreciation or phantom write-offs, which is where I can purchase something like a house and get a write-off even though it might be going up in value, and even though I may not still have put any money into it, because I wholesaled it and I burned it, so I have zero money invested, but I still own the asset, so I can still depreciate it. So the idea is that whatever money that you make is you want to keep as much money as possible versus giving it to the taxman. If I can figure out a way to buy an asset that'll allow me to, depreciate my income so I pay less taxes, it's even better. If even better than that, if I can not spend money in that asset, again, a phantom, and I can go pick up something via financing or whatever, they don't have to put a lot of money into it, and then I can save that money in taxes. Again, an example of $100,000 income, $72,000 car write-off, even though I didn't buy the car, the tax savings that I received by not getting taxed on that $72,000, if I can take that money and then I can put it into another asset, and then that asset can actually pay some kind of cash flow that can pay for the other asset off that I'm financing, that's kind of a loop back circle that I want. But the main point is all the hard work that I have, the 40 hours I put in, all the work that I put in, I'm able to keep that revenue. If I don't keep that revenue and I send it to the IRS, then that means it's just gone. If I can keep that money, keep it in my wheel, have my assets, and everything I have and is actually making money, that stuff starts to snowball and snowball. So it gets very complicated. I understand. Again, I really encourage you to go back and watch the last couple of videos, rewatch them, maybe watch them a couple of times if you're not getting 100%. We are going to continue to build on it, but you got the idea. You got the idea, okay? So from here, that's it. That's it, guys. So we did credit, we did leverage, we did different kinds of investing, and then we did taxes, and we gave you some examples of that. Going forward, we're just going to talk about some, for like the next, I think it's like 20 slides or so. They're going to be shorter videos, but we're just going to start putting all these principles into place, and we're just going to be talking about different things that I want you to be thinking about as you're deciding along this journey. We're going to do a capstone. We're going to put it all together, and I'm going to tell you about my personal experience and how I talked about a couple of stories, but I'm going to talk about my personal experience and how I put all this stuff together through my journey. And then from there, that's it. You will have the pathway of nothing to something in a very short period of time. You'll know exactly what you need to do, how you need to be thinking about investing, and all so forth. The next thing that can really get you to help you implement is to get into our social media, get into our community, and then just start seeing people doing it. Seeing people talk about it. Attack all the resources that we give on Medipity.com. Read the different books about the, even if you're not interested in wholesaling, go read about it just so you understand it. Go read about the different areas. Go listen to the podcasts. Go do all the different things and just start immersing yourself. You do that for the next 12 months or so, you're going to know exactly what you need to do. And hopefully already it's starting to open your mind about going, it's not just about getting going to school, getting a good degree, going to get a really good job, and then just working your heart off as much as you possibly can and grinding and saving. It's actually almost everything opposite than that. If I was going to tell my children today, should you go to college again? I don't know, because you can do so much more. You can do so much in the time that you're going to go to college and start getting going. I think you can earn enough income and acquire enough assets and do whatever that you're probably a few million in by the time that other person is even left college. So we'll leave it there. Until next time. Again, if you don't understand it, please go back and read or rewatch because we only build on it. And if you're not there already, go to Medipity. I'll see you there. where you can answer all your questions directly to me, and I do my best to answer all of them.